Hello, welcome back. In this video, we are talking about Match Group, which is the company behind many dating services, it's like Match, Tinder, and things of that sort. I believe plenty of fish as well. And so, this is a company that has fallen a lot. If you take a look at its stock price, about 60%, 61%. Been going a little bit up in the past session, but overall it has been going down. It also had seen lower prices about a month ago or so. And if we take a look at the 3 month, you will see that it has been around 68 or so. The 5-year chart displays a story here of a company that has been going up and then down. Again, 61% almost is what is happening right now. So let's examine the financials here. This one is an interesting story because you are going to see something that is a little bit innovative in terms of the discounted cash flow model. And I will explain a little bit later. Now, the price to earnings ratio, you will see that it is high, 73. And the price to free cash flow ratio is 24.5. As you can understand, one of these suggests that the company may be potentially very expensive. The other one suggests that the company may not be as expensive as you would think. So which one of the two is the truth, really? Now, typically, we don't want to have a disparity between it, or a large disparity between the PE ratio and the price to free cash flow ratio, because when a scenario of that thing happens here, it probably shows that we are getting extra free cash flow because of the adjustments that are happening because of non-cash expenses. Yet the earnings of the company are not as stellar as the price to free cash flow ratio would indicate potentially here. And so we will examine the finer details, of course. Now, the outstanding shares have been also going higher and tremendously higher. Take a look at this insane dilution going on here, which would also make the company more expensive than you would want in the long run if they keep diluting you as a shareholder. You don't want this to be happening, and this seems to be happening quite a lot. Going a little bit sideways almost in 2021 to 2022 is not as much of an increase, but the previous years, take a look at this increase. It's insane. Now, the company has some debt here. It looks like may not be terrible in terms of the total liabilities, but take a look at the revenue growth, net income growth going down. It's only the free cash flow growth that has been piling up here. And this can actually really confuse a discounted cash flow model that is not created to actually include both the revenue growth, net income growth, and the free cash flow growth. A lot of discounted cash flow models only take free cash flow into account, and that's a little bit of a mistake. And again, I will explain why a little bit later. The total equity of the company has also been going down into negative territory as well. And the debt to equity ratio is negative because equity is negative here, and of course return on equity is also negative. The margins of the company are right now sitting at about 9%, and they used to be near 20 at some point. And overall, we are a little bit on the fence about this one. We're not entirely sure what is happening. So we need to examine the income statement, balance sheet, and cash flow a little bit. Now, the revenues of the company, take a look at this. 2017, they were at 3.3 billion, and now they are at 3 billion. So it's down. The revenues are down from 2017. And if you take a look at the net income, even though the revenues are actually down over here, you will see that the net income is about the same, 304, 305 here to 277. So a little bit of a decline, actually similarly to what you're seeing here in the revenues. Now, as the net income goes down just a little bit to match the revenues, you would think that the same thing would happen with the cash flow, right? Now, let's take a look at the cash flow statement quickly here. And again, remember that the net income has been going down, 304, some increases in between, but right now 277. But take a look at the net cash from operating activities, which is basically how the free cash flow gets derived. For 416 here, it's about double here. So that doesn't make a lot of sense, right? We have less net income than 2017. You would expect this net cash from operating activities to go down, similarly to what they did in terms of profit, of net income, right? It's not the case. Why? Because of this change in working capital in this case, because this was added back to the cash flow statement as an operating activities cash flow here item, and this actually really increases the operating activities cash flow. And if you take it back to the previous years, you will see some kind of similar situations like 2020 also, other non-cash items here. These are more than likely a one-off here. And 2019, another one over here, which is quite significant. And if you take it to 2018 over here, you will notice that the operating cash flow over here was about 1 billion, And this is probably the only one of these years where the actual cash from operating activities did make more sense compared to the other ones, to the rest ones that are upcoming. So these are indicating that these non-cash items could actually really be affecting the operating cash flow that the company generates. Because remember, 2017, 304 here, 416 over here in terms of operating activities cash flow. So you would expect this kind of match here. Yet again, this is 4 times as much as net income. So this is probably not very healthy here. Now, if you take a look at the capital expenditures, they are about the same every year, like 40, 70, a little bit of the odd one out here, but about this. And the company has been, for the most part, getting a little bit of debt here as well. Now, they do have about close to 1 billion in cash, but you will see here, remember, the free cash flow is the only thing that is going higher. 341, 900, 800, 759, and 832 is the only one that's sitting much more, and it keeps increasing compared to the net income and the revenue that the company generates. Even though the past 4 years has been relatively steady, it's still much higher than the net income would suggest, or than the revenues would suggest. And so if you take it to the stock evaluation tool here, you will see a little bit of a weird story. And the very easy way to think about this one is just by taking a look at the free cash flow margins here. Take a look at the margins. They are way more than 100%. This is the only one, 2017, which really matches what kind of margins you would expect. And this is 144, 185, 591, and 300%. Not very healthy here. Again, this kind of happens because we are getting these items added back to free cash flow, to the operating cash flow, because they are non-cash expenses, and the actual net income that the company generates is significantly lower to this. Now, you will see here, for instance, that for a revenue of almost 3 billion, the company made 300 million here in terms of net income, and this translated to 832 million in terms of free cash flow. Now, if you use a model that doesn't take into account any of the revenue growth, the net income, and things of that sort, and it only takes into account free cash flow, you could go something like, let's just say this will grow 10% every year, and then use a discounted cash flow model. This will give you a much higher valuation here. It will give you a much higher discounted cash flow price to buy the stock for. But if you go through revenue and actually project through revenue and take into account the margins that the company has been generating, you will get a much different result, which is going to be much closer to the truth, really, to what you would want to pay for the company. So let's do that. We're going to go here. Let's go 4, 8, and 10, just for 12, just for the sake of it. Let's just think that the company will do that. This may be a little bit aggressive, but let's see what we're getting out of this. Now, the net income margins that the company is having the past few years are about the same, 7, 8, and 9. The free cash flow margin, though, again, it has been tremendously higher because of this discrepancy that we saw. And for this one, we are going to keep going higher. We're going to kind of keep it high, what the company has been doing. And even if we do that, we'll see what kind of results we're getting. And an annual return of 13% is what we typically want to see, right? Before I hit calculate, I forgot to actually show you something which has to do with the balance sheet. Let's take a look at that first and then revisit our page here. I will show you something that can deeply affect what we're getting out of the free cash flow. And this has to do with the total equity here. First, you will see that it's been 3 billion in 2017, and then it's been growing and then going down and being in negative territory. Remember that working capital changes can actually affect free cash flow. And so working capital is basically current assets minus current liabilities. And if you take a look at the current liabilities of the company, you will notice that they went from 500 million here to 1.1 billion, significantly increasing their current liabilities over here is the ones that need to be paid in the next 12 months, pretty much. And of course, when you do that, you can actually subtract that from the total current assets, and you will see the change in working capital if you do it between the 2 years. And this is what got added back, for example, in this last year. The change in working capital is what you are seeing here for 100 million, which was added to the net cash from operating activities here, affecting our cash flow quite significantly here. And this is why it's giving us a value of 800 million in terms of the free cash flow here. And this kind of tricks can kind of really skew your results on a discounted cash flow model if you just go with the free cash flow and don't take these things into account, really. Now let's go back to our our actual projections here and hit calculate and see what we're getting when all these things are factored in, you will see that our high estimates are sitting at 37 bucks over here, while our current price is sitting at 71. And if you take this kind of projections to other discounted models, you would potentially see values of like 70 or 80 or even more in some situations where they're just taking free cash flow into consideration for growing their discounted cash flow model. But this one, again, because it's taking into account all these considerations, it's actually projecting from free cash flow, from revenue, and then it's projecting free cash flow based on the net income, the margins, and the free cash flow that the company has been generating in the previous years. And so this is why it kind of catches the situation where you can be deeply affected by the increasing cash flow that happens in a little bit of a weird manner every year, or at least many years that have been deeply affected. And so again, if you use the model that just begins to be calculating from free cash flow, you could be having this one-off year where the company actually had a change in working capital, or they added a ton of things back in the free cash flow statement. The previous year may have been 300 million, and then you can get a much inflated result. While when you go with revenue, this is much tougher to happen. So hopefully you enjoyed this one and it gave you some ideas on what to do with Match Group pretty much, and kind of what can happen, what can skew your valuations in terms of free cash flow and what is going on with the cash flow statements. Thanks for watching this one. Please remember to leave a like and subscribe if you did like this one, and I'll see you soon, guys. Bye bye.